It was a really great job, really valuable information. This was the investor perspective. Now we're going to have a panel come up that will be comprised of people that have just been through the funding cycle, and they're going to tell us some of their experiences. So on our company panel, we've got Kevin Linane from Vinome, Omar Paul from, I'm going to get this wrong, Akinetech, thank you, and Matt Howard from ZoomSafer. Let's welcome them up.
Nice. Glad you guys emptied the pockets of all the money.
So we'd like to give you guys a chance to introduce yourselves and tell us about the funding round that you've just, and we've just lost our power, so hopefully we got the voices. So tell us about your funding round. Tell us, a little bit about yourself and about your company.
Sure. So my name is Kevin Linane. I'm the founder of a company called Vinome. We closed a $500K round at the end of November. We had some investors from the Dingman Center Angels, a couple of private guys from Google. I had a VC involved, and made the rounds at the DC nursing homes, like Jonathan said. So it's been successful, and we're proud of that. So, and Vinome is basically a.
People willingly invest, or when they were asleep?
They're not really sure what they do.
Just take the rings and the jewelry.
Yeah.
The elderly ladies.
Basically what Vinome does is figures out what the stuff is in video. So we automatically try and figure out kind of what you're wearing and what the objects are in the video, and then we provide that back to large and small publishers as basically purchasable data, kind of per minute. And you can use that data for a variety of things, like clickable video or ad targeting and search.
And my name is Matt Howard. I'm the co-founder and CEO of a software company called ZoomSafer. We build software for smartphones and tablets to promote safe and legal use while employees are driving company vehicles on the job. We have the good news, and I think sometimes the bad news, depending upon your perspective, is that we've raised $3.5 million through Series C&a half at this point from one angel and two sort of super angel investors. It's an interesting ride. It's a journey, and I mean, at this point, I think I'm, fortunate, and at the same time, sort of still learning every single day what it's like to manage, capital in your business. And there's pros, there's cons, there's good, there's bad, and there's sort of indifference. But at the end of the day, with capital, we have an opportunity to build a business and attack a market. So.
My name is Omar Paul, and I'm nowhere near these guys are. So 8 months ago, I was still working full-time, and I quit. And I've raised 70,000 in angel funding, and I have between 150 and 200,000 in non-recurring engineering funds, which I just learned about a few days ago, from an incubator that we're in the process of. So I guess I have to pick one or the other pretty soon. So mine's not 3.5 million in Series C, but hey, 8 months ago I was doing my job, so this is good, eh?
You're probably a lot.
Yeah.
He's probably a lot less diluted than I am too.
Yeah.
Did you say diluted or diluted?
There is a distinction. That's what the lawyers worry about, the words.
Sorry? Oh, yeah. So, of course, it has nothing to do with what I have experienced, and which was one of the reasons why I found it tough to raise money. It's a game which is a virtual stock market where you trade celebrities. And the people you trade is an input into a digital reader magazine. So the idea is that the people you play are trending and popular celebrities because the game forces you to do that. And then who you play forms the basis of a digital reader celebrity magazine. So I'm going after people and all of those.
I got Jeremy Lin.
Huh?
I got Jeremy Lin.
Yeah, there you go. So the idea is that, the trending and the popular celebrities forms a digital reader magazine with stories and posts and Facebook, things like that. So that was the concept, and that is the concept. And so.
All right, so gentlemen, starting this time with Omar, going down the line. One of the things we talked about, everyone knows it's tough to raise money in this environment. It has been for a while. I'm old enough to have practiced and raised money for companies during the dot-com craze of 95 through 2000, when just about anything written on a paper napkin got a $10 million pre-money valuation and a couple million thrown at it. Those days are long gone. So how did you guys come to pick the investors that you got? Family and friends, or as we like to call it, 3F round, friends, families, and fools, or the did you find family and friends? Did you have you mentioned Dingman Center? There you go. And did you have multiple choices, or did you so how did you come to get the entrepreneurs or the investors that you got for your idea? And were you pretty much, did you have some ability to negotiate, or were you kind of like you had to take what you got?
Right. So in my case, I guess, that's a good question. I didn't even know where to start, right, to raise money, because you've never done this before, a first-time entrepreneur. But at the previous company that I worked at, there were people I knew who had been on boards of companies and things like that. So I just reached out to them when I quit. And I found that was the most important thing, that I quit. Right? Because everybody I've spoken to have said, oh yeah, that's a cool idea, and you need a team. And I know I need a team, I mean, really. And oh yeah, you'll have struggles here. But when they say how much skin in the game you have, I can say I have a wife, I have 2 kids, the older one's 3 years, and for 8 months I've been on her health insurance, and I've used my savings. See, right away every investor goes, okay, yeah, he cares. Right? He cares about his idea. There's a commitment there. He's not going to run. So that was the first thing. The commitment was important. And then the second thing was I just waited. I guess I pitched the idea. I went here. I went there. I did a few consulting gigs on the side to bring in the money. And then there's an incubator, and then you meet somebody else who knows somebody, and before you know it, 30,000 becomes 70,000, and a rich uncle says, oh yeah, if he's going to give you, I'll give you 10. And then you run into accredited investing laws. So you can't take money from the old grandmas, yeah, right? You can't do that. And then suddenly that goes down again.
You can if they're Mrs. Howell.
Yeah, I
those of us
guess.
old enough to know Gilligan's Island.
No, I don't know that. Sorry. Showing his age. So that's where I found it. So I don't have that much of a choice. But then again, I'm not looking for that much, right? I'm not looking for $1 million or $2 million. I'm looking for enough to get the prototype, the proof of concept. And the second thing is, almost everybody will want a prototype. They want a demo. So if you've got a team of 2 or 3 people who can build it, that's awesome. If you can't, don't really waste your time. Get it built as much as you can, as quickly as you can. Get it built. Show them something. So.
Yeah, in our case, it was sort of 2008. We had an idea that somebody might actually want to apply a policy to a phone to prevent somebody from using it to text, email, or browse while they were driving a car. And this was sort of an interesting idea, and we went out and sort of built a prototype. Myself and my partner, we funded about $25,000 a piece to go out and buy a patent that was pending at the time. So we had 50 grand in and a prototype, and we went to a very high net worth individual who's a friend of mine, and said, hey, look, this is a pretty neat idea. We have no idea, full disclosure, this could be a complete waste of your time and money, but if you want to write us a check for $250,000, we could probably prototype this thing and learn a lot in the process, and maybe it'll work, maybe it won't. So he stroked a check for $250,000 in a convertible note, which basically means it's debt. We might have to pay it back, maybe not. But the practical reality, it didn't convert into equity until we'd spent the $250,000, built a prototype that generally worked, and sort of proved the concept, at which point he wrote another check for $750,000, which converted that into equity, and there was our Series A round. We subsequently went, at this point, and spent, $1 million, refining the prototype, sort of, acquiring some proof of concept customers, generating a tiny bit of revenue. And then found ourselves sort of on the front edge of what was some pretty good timing. There was a lot of people, including Oprah, talking about this issue of distracted driving, and it's, oh my God, everybody's got to stop it. But nobody knows how to stop it without perhaps some type of governor in the equation. And so we had the benefit of some good timing and some good sort of better to be lucky than good in terms of timing. And we basically took advantage of that. And we got a little bit of VIG going on our B round where we had multiple investors interested. We, didn't waste time, quite frankly. I mean, honestly, I was, a couple weeks ago, I was at a meeting and I heard Gene Rikers from Valhalla Ventures made a great statement at one point, just for what it's worth. He said, look, there's 11 things you need to do when you're starting a business, and the 11th is raise capital. Like literally, there's 10 other things you have to do before you raise capital. And so from our perspective, we were very focused on the 10 things that we needed to do before we had to kind of get to that next round, which I think served us well. We raised a B round on a decent up value, and then raised a subsequent C round with kind of a big boy grown-up institutional investor in New York, which, as I joke, is sort of a good thing, bad thing, because now you're managing a true professional investor. And it's, the bottom line is, for me, it's a learning process, and getting good at governance, learning how to manage capital is learning how to manage your business. So I find that it's very, very valuable in that sense. But at the end, we're into this now. It's almost 4 years. It's $3.5 million of capital. And honestly, I look at my investors, every quarter in a board meeting, and I tell them I give them the revenue, I give them the funnel, I give them the channel distribution, I tell them where the opportunity is. We run the numbers this way, that way, and every which way, and we kind of look at one another in the eye and we say, is this going to work? And we sort of don't really know at this point, but it's okay because there's perfect governance. This is innovation at its finest, and we definitely have a fighting chance. And so as far as I'm concerned, my investors know everything. Somebody made the comment earlier about transparency. The one thing I would say is that if there is even the slightest bit of bad news in the business, be very transparent, be very upfront, because no one likes surprises, especially equity investors. So from that perspective, we're in it together and we feel aligned, and it works.
I think I forgot the question. Just as kind of background, so I started Vinome in May of last year, and I agree with what everyone here was saying. I think there's definitely a premium on prototyping. Like I think both of you guys echoed that, and I think without I didn't have a business plan, I didn't write a PR requirements document, and no one gives a shit about that. When you're pitching people that are going to give you 50 or 100K, particularly early stage stuff, very, very few people asked for a business plan. And I was sort of like, look, you want me to work on the prototype and the product, or do you want me to spend, 2 months working on a business plan? And so that was interesting. And I think, I sort of chose that path of the prototyping. I think it was the right one. I think there's a temptation to do a business plan. I think if I could do it again, I certainly would do it the same way, which is really just like you guys said, focus on building something that you can show and prove your concept. And then I think, in terms of how I selected my investors, I did actually wind up getting a term sheet really early on, and it had kind of these funky terms. And I remember thinking, boy, I wish I had done this before, because I really don't know what to do. This is really exciting, but I don't really know what to do. And so I basically just asked everyone. I was like a constant polling machine, and I talked to my lawyer, and I talked to other people that had raised money before, and kind of basically found out that this original term sheet that I got was really irregular, and basically it wound up having me committing and signing a document and then waiting for 3 months for a decision and money, and there was a non-compete and all these things, and sort of locked my price in from my end.
Was this an angel investor, institutional?
It was an angel group, actually. It was an angel group in Tennessee, and so they tried to lock in the valuation and then have me pitch all these people, and they said, and we'll reserve the right to put in our amount at the end, and we can decide whether we want to or not, but you can't shop this around. And it was hard to turn that down, because I was so frothed at the idea that I could have a term sheet, quote unquote, signed. But I did, and it was just a really wise decision, because I wound up closing the round a month later without all that fluff, and they were going to have me pitch for 3 months to all these people and all over the country. And so so it was, I think, from a selection standpoint, it was really at the beginning more about just making sure that I didn't write myself into something that was sort of not sensible. And then in terms of picking angel investors, you know, I will say that I think AngelList is, I know that Jonathan mentioned this, it's really an incredible tool, not just from like it'll connect you to angel investors. I probably raised half my round through AngelList, but it really like allows you to think about, it's almost like when you do LinkedIn, you kind of figure out how you're going to do your resume. That's kind of like what AngelList is for your business. Like you get your stuff down, you get your little elevator pitch down, you get your swag down. It's got a place for everything, and it kind of makes you fit your business in a way that is really valuable. It's a good exercise, even if you don't raise money through it. Am I getting the hook?
Are you getting the hook now?
Looks like I'm getting the hook.
No, you guys have been great. Go ahead, finish up, and then we're gonna.
Yeah. So anyway, long story short is I sort of took a lot of the money that a lot of the early money that came in I took. I didn't really turn down too many investors, but I was really more about speed. Like I didn't want to spend a lot of time raising money, and so people that could commit quickly was important to me because there's a real value associated with if you're 3 people like we are, and you have one person that's off all over the place raising money. There's value that you lose by spending 6 months raising money. And so my only thing about investors was speed. I mean, there was a certain amount of fairness and ethics, but speed was really important.
Great, thank you much. So we've gone a little bit over time. Can I just see by raise of hands how many questions you have for the panel? If you have a question. Okay, why don't we take all 4 questions? We'll let you. Everybody gets to answer whichever question they want to of the 4. Okay. So. Okay.
Question roulette.
Go ahead. Question roulette. There you go.
When do you engage like an attorney and a lawyer?
When do you engage an attorney? We're definitely answering that question.
At the very beginning.
No need to take any more. No. Other questions? What were the other ones? Go ahead.
Did you all have a team in place when you started seeking funding, or were you like individual? Like you sound like you're an individual.
Yep.
And you don't have a team, right?
Nope.
Don't answer. Did you have a team in place when you started funding? Other question? Yes.
So in the past 6 months, maybe a year, there's been a lot of headlines about Kickstarter and how it's really changed the investor platform, or the ideal, how people actually raise money, and they can do it almost socially now. Your thoughts on that?
Those are 3 great questions. One more. Go ahead.
This is probably best for the young guy, but I'm just curious about traction and or metrics that you have to demonstrate to investors.
That's a great question. So, you know, what sort of, you know, did you have to have revenue? What were the metrics that were critical to getting the investment in the door? Okay, we'll start with you, Omar. Which question you want?
I'll take the team one because, you know, every VC and investor will tell you you need a good team, and you do, right? But when you start off yourself, you don't have a team, you have you, right? So all that means is that you just take slightly longer to do it, that's all. It should not be that you should give up. Because if you persevere and if you commit, even if it's for 3 to 6 months, it shows in the end, right? You get your pitch down, you begin to understand what it is, and don't waste your time on a business plan like Kevin over there says. Well, one thing that I found really helpful to do was I did a revenue model, right? I put a spreadsheet together, and I got this from somebody else, and I just put down and I started to see, okay, how much are other people?
That's the clue.
You're out of time.
Right, yeah. Do a rev model, not for any other reason, but so you understand how much are you going to basically spend and how much are you going to make. And because if you do that well, you understand your market. It's not that you'll get a good result. You'll know your market. You'll be able to talk a little bit better about it.
I'll take the Kickstarter one. I mean, I think it's, you know, Kickstarter exists for a reason, and there was a comment about it earlier. I mean, the capital markets have changed dramatically in the last 5 to 7 years, and you know, early stage, quote unquote, true risk capital, as the saying goes, is very, very difficult to come by. And your traditional sort of, you know, multi-hundred million sort of 4th, 5th fund VC isn't touching that stuff. I mean, there's some recent data that just came out based in terms of deals that have been done locally here, and you know, you'll see CIT, you'll see sort of state taxpayer-funded organizations doing lots of little deals, where $50,000 is the new $5 million for seeding a business. And you know, Kickstarter works for a variety of reasons. Y Combinator and Techstars and 500 Startups, it all works. I mean, the Fort works for a variety of reasons. I mean, the barrier to innovation in developing software has never been lower, so really smart guys can do really amazing things, and girls can do really amazing things with, you know, few dollars. And and create that prototype and prove the opportunity, prove that somebody's willing to open up their wallet and spend $1 for something. And, then maybe you actually have an opportunity to kind of prove that the model is truly capital constrained and raise capital on more favorable terms. That's the other point I wanted to make about the comment on when do you engage a lawyer. I mean, the beautiful thing about the world we live in now is everything is transparent. So what used to be the black art of financing terms is no longer a black art. If you want to read how it gets done and you want to read horror stories about who got screwed by who with which deal and which term, it's all out there. And a little bit of time and a little bit of effort, and you can make yourself, I'm not saying a lawyer by any stretch of imagination, because these guys are far, far better than any of us could ever hope to be, but you can educate yourself pretty well, so by the time you do pay a lawyer, for their engagement and their time, that you kind of have an idea of what you're willing to accept, what you're not, where you want to sort of negotiate, and where you want to draw the lines.
A quick comment on that from our perspective is we love it when an entrepreneur comes to us who is already pre-educated and uses us, asks the right question, and uses us in a great way. Because the one thing we can't do is charge a gazillion dollars to do a Series A deal. And so if someone comes complete neophyte, asking a lot of simple questions, it just racks up our time that we can't bill for. So we end up losing a lot of our shirts on a deal. So, and we sometimes do that and hope that the company gets to do its B round, C round, and an IPO and everything else. But essentially, it's really important to us when people come, educated.
So I'll take the last question, I guess, since it was directed at me. And I guess maybe actually one more comment on this. Just to specifically answer your question, I involved lawyers like super, super early. So guys like Womble or Cooley, they'll do stuff for you that is, they'll work with you in a way that they're not going to, you're not going to get billed like Deloitte or some big company that uses, legal services a lot. You'll get billed in a way that makes sense for your company. And so I'm already experiencing like patent troll litigation and all kinds of stuff that I wouldn't be able to handle if I hadn't involved people really early on, and that was an important move for me for sure. And then on the traction side of things, I mean, it's not like I certainly didn't have like a lot of big customers or really any real customers at all. What I did is I went out to, I developed this prototype and I basically pitched it like I was pitching investors, and I said, look, would you use this? Like, can you look at this and tell me if you would use this? Imagine this looks a hell of a lot better than it does right now and works perfectly. But this concept, would you use this? And I got a couple people to say, yes, I would. And then I got their numbers and I said, look, maybe some people will call you. I kind of put them on an investor FAQ. And I said, here's some people that said they'll use this. And that was my traction. And that was the fastest thing I could think of to get done. It's hard, especially when you're like me and you're B2B, where you have these long enterprise sales cycles. It's really hard to get a customer that takes 6 months to sell, to get that before you get your seed investment's a challenge. So that's one way.
But by the way, just to that point, one thing we did, we never wanted to be in the consumer market, but we threw our app out there for free, and we let every mom come and take it and sort of put it on their 16-year-old daughter's phone to prevent her from texting on the way to the mall. And we used that as a proxy for the employer-employee sort of liability opportunity that we're now focused on. So, prototype, lather, rinse, release, test in the wild, where the barrier to customer feedback is near zero. Anybody will try software anymore. It's like crazy. Doesn't even have to it can be buggy too. They don't seem to mind.
They blame AT&T or something like that.
Well, that's great, guys. Let's hear it for our company panel.
Thank you. Thanks a lot, guys. I guess I'd also add that, the MoDev community is a beta testing community for, developers. So if you've got an app and you need it beta tested, let's send it out to the list. We'll get those out there and get your beta testers lined up. So be sure to leverage one another early in the process. It will really help you with investors. Talk about metrics. You then have metrics to actually talk about how people use your app and the feedback that you're getting. So leverage one another.